it's nice to see on a Friday that markets are green in comparison to what we've been seeing during the week, red most parts of the week. And we know that there's been a lot of concerns coming through from the US, from Europe as well. Of course, the euro dollar also having a big hand in the market movements as well. But where to from here?
Look, in essence, we are now going to be bombarded with good news, simply because the base that you're measuring off is so low, there's so much cheap money around, that the environment for equity, certainly, let's say for the balance of this year, is probably going to be okay. But I mean, understand the easy money's made, I mean, with hindsight, obviously. But today's market was very strong, led by the resources, led by Anglo-American. It went up very, very strongly, and all that happened was that US retail sales, instead of being minus 0.3%, comes in at plus 0.2 or plus 0.3%. So the market is looking for a little bit of good news. I mean, maybe our market's been a little bit too enthusiastic, seeing as though the Dow is only up about 1/4 of a point. But certainly it is looking for good news, and when good news happens, market goes up quite strongly.
All the retail sales in the US did rise 0.3%, and people were expecting a minus number purely because of the weather, and of course quite a lot of concerns coming through about the sustainability of the recovery in the US. But this isn't clearly a strong enough number for us to get relatively hopeful in the US.
Well, look, I suppose everything's at the margin. Investments, in essence, is at the margin. So when something comes in slightly better than expected, the market will jump on it, or slightly worse than expected, the market will be punished. If you look down into the numbers and you take out motor car sales, the actual sales figures are up at about 0.9%. Now, this is, understand, month on month. It's not, it is, I suppose, it doesn't sound like much, but it actually is a relatively significant type of number that does come out in these retail figures. But of course, the University of Michigan's consumer confidence is probably more important. If that shows a nice uptick, the US market will probably be quite strong today.
Well, maybe we'll be seeing some good news on the economic front, but looking at some of the results that we've been seeing, Wayne, some companies doing quite well, others really battling through the tough times, but most companies say that things looking ahead could remain relatively tough, and apart from that, they are expecting a robust recovery in 2011. In fact, we've got views from all the CEOs that we spoke to this week, including Sanlam, First Rand, Old Mutual, MTN and Sasol. Let's take a look at what they had to say.
The key feature of these results is the impact of currency, because almost 80% of our earnings are now non-rand earnings. When the rand strengthens, you see the impact, and that's almost 3 billion rand of impact. Currency is one thing that we can't control, but what we try and do is, try to ensure that firstly we maximize loans that the operations take, and put a natural hedge by them raising money in country with the local banks, and therefore have the component of dollar-denominated debt or hard currency-denominated debt per operation being reduced. So that will hopefully reduce the oscillations and volatility in those functional losses on currency.
The single factor that makes us cautious in our outlook for the rest of this financial year is the rand, because 10 cents change means 800 million rand on our operating profit. So this is hugely volatile, so we must remain cautious because we don't know where the rand's going to go. We find it very difficult to predict the oil price, as most people do, so we would see it staying in the band of probably $70 to $90 a barrel in the next year or two. Beyond that, though, and this is important, the dynamics as the world gets out of this recession over the next couple of years, we would see that the dynamics are such that the oil price would increase quite significantly. So as far as our long-term projects are concerned, we're a bit more bullish about the oil price than that. We see oil price for the remainder of this financial year remaining certainly pretty much where it is at the moment. So for the full financial year for Sasol, it's only really just into the 70s. So that I don't want this $90 top end to be misinterpreted in any way.
I think it is going to take a while before the household debt to disposable income, which is by the end of December was sitting at about 78%, improves significantly from those levels. And therefore, the repair of the balance sheets and the deleveraging that still has to happen will take a while. And therefore, even though we're seeing an improvement and the confidence levels are certainly improving, I think the improvement you will really start to realize in 2011. Well, as our performance, particularly in terms of earnings, improves, we should see return on equity also start to improve. But I think it is important to mention that the sustainable level of return on equity will be somewhere in the lower to mid-20s.
What we confirmed today that we are exploring the disposal of our US life business. We have also said that we've decided that we are going to look at IPOing part of the US asset management business. We have over $250 billion under assets under management there, and we think a structure of a listed entity may be better for shareholders.
What we'd like to do with the money is to actually invest it in tremendous and good growth opportunities, and we've identified a number of them, smaller ones. We're not going to bet the farm. That will take care of a fair chunk of the surplus capital and the discretionary capital. The focus areas being, investing more in our growth businesses in South Africa. We have 2 or 3 great opportunities in Africa that's been identified. India still provides good opportunities by investing more capital into our businesses there. And then, with what is left, it is really finding other opportunities in the next 6 months or so. And if we can't find them, then returning capital. But with a special dividend, there is a leakage of 10% STC, so we actually prefer the buyback route.
Well, there you have it, a summary of all the news out this week. Wayne, your views on, let's start off with MTN and Sasol, both companies citing the strong rand as a very big issue.
Well, look, Sasol, at the end of the day, the oil price actually looks fine. It's trading over 80 today, but they need a little bit of rand weakness thrown into the pot.
10 cents move on the rand, 800 million rand.
That's huge. Look, and if you actually look at the heavyweight resource shares, Sasol has been lagging, and yet the resource, the resource indices have actually done very, very well, along with oil. So you would have expected Sasol to go a little bit better on that. MTN, very similar story. I mean, MTN generates massive amount of cash. I wouldn't say their capex is behind them, but the majority of their capital expenditure is in fact behind them. I still think they're going to look for acquisition opportunities that are coming forward. Overall, the MTN result was fair, but it wasn't great. It wasn't a fantastic set of results.
Sanlam sitting on 3.5 billion rand, and they're saying they're looking for opportunities, and if they don't find anything within 10 months, then of course they'll be giving value back to shareholders as well.
And I think Johan's correct in saying rather buy back the shares than pay out the dividend because of the STC. Now I think that whole tax rule or tax regime is going to change, but I don't think it makes any difference between whether you buy back shares or actually pay out a dividend. I think there is still some tax leakage on that, and we sincerely hope that they spend the money wisely, but Sanlam has got a record of actually spending money wisely on acquisitions.
And Old Mutual says that they're going to be IPOing part of their US asset management business, and we know the US business has been a very big issue for the company.
They've had 2 major problems. The one is the US life, which they've had to recapitalize significantly. The other was their Bermuda business. They're looking at IPOing the US asset management, which is a separate business, which is, I think, if I'm correct, is the first business they bought overseas. Massive thing called UAM that they actually bought there. And I suppose they want to, in essence, release some capital and try and get some revaluation of the share, where at least you'll be able to identify via a separate listing what the value of the asset management business is. But by and large, their troubles are behind them. So they're lucky the markets rallied. It's rescued the US life operations. They had massive investment in debt instruments in the US coupled with their life operations. All of those prices have recovered. So they're probably over the worst for the time being, but they've still got capital issues. They have, in essence, got to raise some capital.
Looking at Bell Equipment, that company came out with results. An interesting company,
very
relatively small, but the loss for the year was 270 million rand. No surprise there, because they are in the manufacturing vehicle side of things. Now,
I still maintain in years to come, university students are going to do business college exercises on what Bell Equipment did to cope with the downturn. I mean, it has affected them severely.
Apparently, their turnover is down, being made by major shareholders. So
major shareholders. Not the first time. They've pumped in money. Maybe a year ago, maybe 9 months ago, they pumped in huge amounts of money. Now that's been taken from 150 million to I think 300 million. But their turnover is down 50 or 60%